From the morning reading, the S&P has a modest decline after a weak employment report. U.S. equity markets took a hit today following a big miss on the May jobs report. The S&P 500 plunged at the open nearly 1% to its intraday low in the first hour of trading. The index then recovered in a couple of waves to nearly scratch for the afternoon high. Some selling in the final minutes led to a modest about 0.3% closing loss. The weak jobs report was likely the result of some isolated circumstances, most notably the Verizon strike. Trading volume in today's mini drama was unremarkable. Week over week, the index price was unchanged. The spider is at resistance day 5. Sellers controlled the open, buyers controlled the close once again. 3 of 9 sectors moved higher on Friday. XLU, XLB, and XLP were the strongest sectors, while XLF was the weakest sector. Breadth advanced as advancers led 1637 to 1398 on the New York Stock Exchange, and also on the NASDAQ 1636 to 945. Weak jobs report pushed bond yields and the dollar sharply lower. Winners are bonds, utilities, and gold. Banks are losers. Foreign markets jump along with currencies. The S&P 500 holds its uptrend. Healthcare sector turns up. The weakest job report in 5 years surprises everybody. The Friday job report had only 38,000 jobs created in May, was the weakest in more than 5 years, and it pretty much shocked everyone. Some of the market reactions, however, were reasonably predictable. Interest rate yields tumbled along the entire yield curve. The 10-year Treasury yield, TNX, plunged 10 basis points and closed near the lowest level since February. Naturally, that pushed bond prices sharply higher. TLT surged to a 4-month high. The reason for that sharp reaction was that the weak job report pretty much took a June rate hike off the table and may have jeopardized Fed plans for a hike sometime over the summer. The 2-year yield, which is the most sensitive to a rate hike, fell even more than the long bond. The plunge in bond yields helped some stock groups like utilities and hurt others like banks. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6 o'clock a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 6th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut this morning, all 4 of the U.S. broad market indices were up just above scratch. Really, nothing was notable. Crude oil up, though, over 1%. Euro just below scratch, bonds just below scratch, and gold up just above scratch. In terms of overseas action, China also just below scratch, Hong Kong up about 0.4%, Japan down about 0.4%, Germany just about scratch, and the United Kingdom up about 1%. In terms of macroeconomic reports in the United States of note today, you have Fed Chair Yellen speaking. Always a potential to move the market anytime she's out in public. And then looking forward towards tomorrow for the U.S., you have non-farm productivity. And let's see if there's anything else. That's about it. So really, in terms of scheduled macroeconomic events for the beginning of this week, very, very, very light. In terms of current volatility conditions, we have been decreasing. You see the 5-day versus the 10-day is down. Short-term VIX down to the 10 handle now, 10.11. Skew also back down to almost the benign level. It's sitting right at the 125 caution threshold. In terms of IV percentiles, we've got 3 of the 4 indices now in single digits, so exceptionally low. The S&P at an 8, the Russell at a 12, the NASDAQ at a 7, and the Dow at a very low 2. No standard deviation moves were put in on a close-to-close basis with Friday's trading action. And indeed, in the last 5 trading sessions, there's been very little significant volatility from price action, either up or down, with only 2 events, one in the Russell and one in the Dow. For the last 2 weeks, a little bit more activity, but still well below normal for the S&P. In terms of the charts, let's go ahead and bounce over there. Here's the S&P charts, and as we've been talking about, this wall of resistance just above the current price action, and you see here we've had multiple days with highs that are right up against that wall of resistance. So we continue to have the same premise, the same theory going forward that we've had until proven otherwise. That this, just because we pop up to 2105 or something like that, frankly doesn't mean anything to me, at least. We really have to start working through this area of resistance. And given the macroeconomic reports for the next 2 days, I don't see any significant impetus to be able to punch us through that anytime in the short term. But we'll continue to watch the price action. We'll need to start to see some probes up here, and then those probes to start to become more successful to move up through this about 30-point range in this area of resistance. Most notably, the initial area is where we've had all these recent touches, but if you go back about 14 months, you're going to see that we've had some prior swing highs that are just above this area as well. So that's why we paint this as an area, not just simply a resistance line or trend line. Given that area, it's very difficult to see enormous opportunities for additional bullish delta. But if you start to see that this breaks through, you may want to start layering in or scaling in additional bullish positions to what you should already have. You should already be pretty significantly bullish, but yet at the same time, cautionary about initiating new positions at this point. Now, if we simply just go sideways, there's a number of strategies to take care of that, and that's probably the most obvious solution to this chart pattern in the next few days to weeks. The other potential, of course, is that we do finally break down, but we've got a lot of support here, and really, just as much as we've got significant resistance, you've got to make the case that we've got a lot of support. And whether you take the theory of the plunge protection team, or the Fed is going to do whatever it takes to keep this market up, or the European authorities are going to do whatever they need to do to keep this market going. There's a number of certainly powerful forces that need to be respected, and I think that's being reflected in these technical charts, and that every time the bears look like they're about to do something, and certainly when we had this near break of the head and shoulders pattern neckline, in came the bulls and took us right back up to the top of this range. Ultimately still not achieving anything, but other than, I suppose you could say, prevention of the plunge. So I guess perhaps that is an achievement in itself. But in terms of actually gaining something on, performance, we're just right back to where we've been in much of the prior 16 months or so now. And if you look at the Dow, I feel like, this has been a lot of repeat lately, but these have been so correlated between the Dow and the S&P, and very much the same kind of patterns, though sometimes in a relative difference. These current swing highs are a little lower than the prior swing highs. So while up against some resistance, certainly not exhibiting the same kind of strength. So that's probably the most notable thing about the Dow at this point. The NASDAQ, also the very same tired kind of story, not really achieving anything on a bullish standpoint, and yet also not breaking down, and you're having to respect what the bears are doing from that aspect. And then with the Russell has made a higher swing high compared to its most recent swing high, though it has significant room to go. And then we talked about this again last week, some 100 points really to go just to get back to its prior swing high. So much like the NASDAQ, the Russell is playing some catch up, but has a long way to go to be in the same place in a relative sense as the S&P. Still, the fact that the Russell has been leading could be an encouraging bullish sign. In terms of volatility, volatility is getting terribly close to those prior lows. And if we get below 13s, you see that is almost always in recent weeks served as the floor. So anytime you get below 13 is probably an opportunity to nibble away at some volatility hedges or other volatility positions. And we're right on the floor being able to do that at this time. In terms of current volatility from the future standpoint, you see we've had basically 2 weeks here of falling volatility ever since you came to that point where that head and shoulders pattern on the S&P had a near breakout, or I should say breakdown, and almost set up, but fired and then misfired as fast as it fired. In terms of bonds, of course, had a very large move on Friday with that jobs report being seen as ultimately basically taking that June Fed rate hike off the table. But look at where it stopped, right there at that former area of resistance. So as big a move as it was, it came screeching to a halt as soon as it came into that former area. So it's significant that it's broken through this area of diagonal resistance, but it stopped at the horizontal resistance. So it basically moved through the easy part and then now has stopped. So we are looking now to see a break above about 167 in about 5:30 seconds. And if it does that, then we'll likely have some resistance right here at the non-wick areas around 168 and 21:30 seconds. And then after that, then we start really moving into open air with not much of significant resistance above that. If that happens, markets are probably rolling over. So we'll have to continue to watch that. In terms of, let's take one quick look at gold. Gold was in the news with the morning authors reading, and you see this huge move here. But basically just a retracement of the recent falling action. So we'll have to see if this truly regains its former bullish posture or if that was just kind of a one-day wonder. Gold has been really, really choppy of late, and very noticeably it was quite disappointing in this failure to hold this area here as this retracement was expected after a move like this breakout here, but then when it broke here and then broke again through this area down here, that was certainly very, very disappointing, I'm sure, to many of the gold bugs. Really calls into question whether this is an intermediate term bullish posture or not. And I think that's probably enough on the charts. Let's go ahead and go to the daily report and a number of subtle changes. And our focus with this daily report, as we look at these market timing signals and risk opinions and so forth, is to pick up on the subtle changes and then also on the rate of change from one day to another. In terms of the market timing signals and that kind of cluster here at the top of the report, this is a very, very strong report at this point. And we didn't just get here in one day. It took a long time and a lot of effort by the bulls to be able to kind of put together this cluster of signals. Right now, our market trend intermediate term phase opinion is in phase 2. That is trend reversal to the bullish side. So that is a very positive aspect. In terms of the 3 market timing signals, these are all mechanical in nature. For the first one coming to us from IBD is in confirmed uptrend. The second coming from GMI index is a perfect 6 out of 6 with a buy signal in place now since 525. From the stock charts decision point scoreboard, our third mechanical signal, you see a very, very clean stack now between the short to the intermediate, and really only the long term is giving us mixed signals. So the clear consensus between these 3 mechanical market timing signals is bullish, especially in the short to intermediate term, with some question marks coming in on the long term, and that won't likely be resolved unless we have established new all-time highs. Position sizing opinions from both models are at 100%. Intermediate term market posture is a severely strong bull, and 3 of the 4 indices, S&P, the most notable one, the one that we use to issue the opinion off of, as well as supported by the NASDAQ and the Russell, in all cases up over 80, and the NASDAQ and Russell up over 90 actually. Only the Dow is below 80, but it is still in its own respectable strong bull intermediate term market posture. This is up against the face of a weak bear sentiment line, but that score is relatively high, and it's a very long-term line, and it had, with the recent action, turned to a weak bear, and so that might want to nullify just a little bit of the scores, keeping that in context. In terms of the intermediate trend strength, it is currently a very bullish, strong trend, well up over 80. Hedge risk status currently still at level 1. That is our caution light, our first level of warning. And if we continue to firm up some of these lower volatility measures, we'll probably see this drop to level 0+, which would be normal with some elevated risk conditions. And we're probably right on the edge of being able to go to that. Indeed, in terms of the special opinions issued for the various key strategies, option income strategies, the VIX is in the acceptable window to initiate new positions for novice traders. Probably pretty much all go on all your types of option income strategies in the current market environment. Really not too much to get worried about other than just normal market risk that's always present. In terms of covered call strategies, conditions are acceptable. In fact, we became even more bullish with the most recent revision here. We've gone to a 3-to-2 ratio of in the money and out of the money strikes. And the construction of that covered call, also a 3-to-2 ratio of low beta and high beta positions, and the construction of your portfolio. So you can, as always, on those more aggressive setups, consider legging into those with conservative setups of well out of the money put selling. That can always help in building some of those high beta positions and maintaining a bit more defensiveness. But we start to increase the amount of bullish exposure a little bit by a time. Indeed, a mix of covered calls and then put selling, especially those more aggressive positions. Remember, we're still level 1, so consider reduced position size and well out of the money puts for both the conservative and aggressive setups, but particularly with respect to the aggressive setups. Consider defined risk positions. We really like to do that. We like to spread off that put selling and have a long put down below it. And then also, of course, position size and the scale that you are willing to own. In terms of the specific warning areas, and this is why we're still at level 1, we have this VIX daily squeeze still present. We have this distribution day count that is in warning status. Though, to be fair, this has been starting to ebb off, and you see the S&P is only at 5. If that goes to a 4, then that no longer would be in warning status, and NASDAQ, not far behind, could fall off. The skew just barely in the cautionary area. And then in the terms of the key intermarket risk aversion indicators, we see we now have one of these as risk off, and another one of these is very, very close to going risk off. So there's a number of things that kind of are flies in the ointment to be able to say that our hedge risk levels in the market are still somewhat elevated from a sentiment standpoint. And remember, these are kind of measuring the emotional aspects of the market, and by themselves they can be very elevated for extended periods of time. They're not signals in themselves, but they do tell us to start to watch for potential reversal patterns. Well, stocks in the short term are pretty high risk at a 9 out of 10, bonds at an 8 out of 10, so at significant sentimental risk of setting up for a reversal. In terms of specific ETFs, semis, if you're an SMH, you need to be watching for potential reversal patterns. In our compilation fear and greed index that we get from CNN Money, you see that we're in the upper quartile, though down a couple points from where it was on Thursday's close. In terms of sector specific, transportation still quite neutral along with retail. In the case of retail, though, you have to say that this has been improving. This was down, 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 and retail certainly has been firming up. Other areas that took a bit of a hit with the action from the jobs report were the financials. We saw this impact coming in. Also, telecom has taken something of a hit lately, and in the short to intermediate term is still in an intermediate term market posture of down, short and intermediate term. So the ones that are generally up, you see the rest of the sectors, and it's a mix, frankly, of those that are low beta and those that are higher beta. So it really is probably right now more of a stock pickers market and more of the individual stories of what's going on, such as what's going on in the telecom with the Verizon strike and potential resolutions there, or what's going on with jobs report and the potential for the Fed, or the non-potential of the Fed, or lessening potential of the Fed to reduce or increase rates with their June schedule. So these are kind of more of probably individual stories going on than perhaps just a broad market coming up or going down. But in terms of percent change, you see the big winners on Friday were utilities, followed by materials, consumer staples, and telecom. That's probably enough with that. In terms of intermediate term market postures that are sector specific and ETF specific, this is still a long, wide, broad list representing both highly defensive as well as higher risk on kind of more aggressive kind of setup. So nothing really to note other than that. We certainly haven't seen any deterioration across that list of late. In terms of the relative rotation graph, this does give us a little different picture and kind of again points to, as we come into this area of significant resistance, many of these ETFs that we think of as being really strong right now seem to be more of a fading pattern than they do to be exhibiting really strong patterns on this relative rotation graph. Now, FDN, that one has been actually on my watch list the last week or so, and it is certainly showing something of note. So keep an eye on FDN and also KRE. And you see here FDN is the internet and KRE is regional banking. They've been performing on a weekly chart basis relatively well. Now, interesting enough, while this might be perhaps something to do with the banking and financial sector, and perhaps related to the interest rates, you see other interest rate sensitive products such as IYR, the REITs, and then of course XLU, the utility sector, have been kind of falling off a little bit. So still over here on the right hand side, this is, you know, our improving kind of sectors or ETFs, and yet at the same time, you know, they're not in the ideal pattern of going from lower left to upper right. That's the kind of pattern that you really want to see is going this direction, and they seem to be retracing in both cases. So a pretty complex story on the relative rotation graph right now, and you know, certainly some cause for concern for the health of the broad market. You know, we sit there and we look at the top of this and we think we should be just kind of all bull all the time and just load up with everything we can buy, and, you know, perhaps have very little cash on hand. And then we start really digging in to some of these, you know, internals of volatility and the key intermarket risk, the sentiment, and then, you know, what's happening with the individual sectors and industry groups. And it doesn't seem quite so pretty as those top line pictures would seem to point out. So this is why ultimately we are still at this hedge warning 1 and not at a 0+, more normal kind of hedge risk warning status. So some fine distinctions there, but this is not a healthy bull market yet. It's a very much improved bull market posture, but it is not clearly, you know, all in a healthy mode. This is not a peak athlete ready to take on the Olympics at the peak of their training and be able to take long, strong bull swings. That's just not that kind of market at all. So we've gone a bit long, as we typically do on Monday, when we often have an awful lot of material that comes in over the weekends. Of course, we had the big 4 macroeconomic report with that Fed, and I should say that the employment report that came in on Friday. So that certainly influences what we do on Monday reports. Let me go ahead and scroll through this very quickly. If you see something of interest, just hit the pause button, and you can go into the hyperlinks for more details about these various opportunities, including how you would actually be able to follow us in the trade room. Disclaimers as always. If you need more time to review the disclaimers, just hit the pause button, and do note the full disclosures can be found at the hyperlink down here at the bottom of the slide. So that's enough for today. We'll see you back here for tomorrow's session of the Falcon Global Market Preview. In the meantime, good trading to everybody.